When you picture your retirement, what does it look like? Now, what if I told you there's a silent partner who has a claim on a pretty big piece of that picture? Today, we're going to talk about taxes. And using insights from the team at Confidence Financial Partners, we're going to walk through a framework they call the Retirement's Tax Triangle to help you see your financial future with a little more clarity.
So, let's just start with a question. As you've been saving all these years for retirement, have you really accounted for your silent partner? And no, this partner isn't your spouse or someone you went into business with. It's an entity that has a claim on your savings, and frankly, it could have a huge impact on how much of that money you actually get to keep.
So who is it? Well, that silent partner is the government, and its claim comes in the form of future taxes. The Confidence team actually has a pretty powerful way of describing this. They call it a tax time bomb, kind of ticking away inside assets that haven't been taxed yet. Just understanding how to approach this is really the first step toward a more tax-aware retirement strategy.
Okay, so how do we get a handle on all this? The key is a really simple framework. I want you to think of all your assets as fitting into one of three distinct buckets, and each one has its own set of tax rules. This is what's known as the tax triangle.
First up is what we'll call the always taxed bucket. This is where you're going to find accounts like your traditional 401ks and IRAs. You got a tax deduction when you put the money in, right? And that felt great at the time. But here's the catch. Every single dollar that comes out, whether it's for you, your spouse, or your heirs, is taxed as ordinary income.
Next, we've got the sometimes taxed bucket. Think of things like your brokerage account or maybe some investment properties. The tax here is, well, it's variable. It might be capital gains tax if you sell a stock, or it could be ordinary income tax on things like dividends. Now, for your heirs, these assets often get what's called a step-up in basis. What that basically means is, when they inherit the asset, its cost basis gets stepped up to whatever its market value is when you pass away. This can really reduce their future tax bill if they decide to sell it. And finally, there's the third bucket, never taxed again. This is the world of Roth IRAs and Roth 401ks. Here's the deal with these. You pay taxes on the money before it goes into the account. But the trade-off is that after that, all qualified withdrawals are completely tax-free for you and your spouse. Your heirs also get to take that money out tax-free, though they generally have to do it within 10 years after inheriting the account.
Now here's a really key difference in how these buckets work. That always taxed bucket comes with something called required minimum distributions, or RMDs. Once you hit a certain age, the government says, hey, you have to take money out each year and pay taxes on it, whether you actually need the income or not. But in contrast, Roth accounts, that never taxed bucket, have no RMDs for the original owner. This really highlights the level of control you can have over your assets, and importantly, when you pay taxes.
So, understanding these buckets is one thing, but why is it so important to be thinking about this right now? Well, to answer that, we kind of need to zoom out and look at the bigger economic picture. The decisions we all make about our money, they just don't happen in a vacuum.
This represents the U.S. national debt. And according to the advisors at Confidence, it's a key piece of this puzzle. As this number grows, so does the government's need for revenue. And if you look back through history, one of the main ways governments raise revenue is, you guessed it, through taxes.
And what about this second number? Well, that's the approximate net worth held by the baby boomer generation. Now, if a government is looking for revenue, that represents a massive pool of assets, and a lot of it is sitting in those always taxed retirement accounts we just talked about. It's just a reality of the financial landscape we all need to be aware of.
This all leads to a really interesting observation from some financial professionals. If you look at the history of U.S. tax rates, where we are right now is, relatively speaking, on the lower end. And this has led some to believe that we may be in a strategic window for some long-term tax planning.
So, here's the crucial point. Just like you diversify your investments to manage risk, you can also consider diversifying your assets by their tax treatment. This is really about strategically positioning your assets across those three different buckets over time, all to align with your long-term goals.
One well-known strategy for tax diversification is the Roth conversion. Conceptually, it's pretty simple. You're moving money from that always taxed bucket over to the never taxed again bucket. The trade-off? You have to pay ordinary income tax on the amount you convert today. Now, let me be clear, this is not a one-size-fits-all solution. It's a strategic process that requires really careful planning based on your own individual financial situation.
And it's so important to remember that tax planning, as critical as it is still just one piece of a much bigger puzzle. A durable, long-lasting retirement plan coordinates multiple areas of your financial life so they all work together.
You see, the Confidence team views retirement through the lens of 5 interconnected areas. You've got income, tax, investment, health, and legacy. A decision you make in one area, like taxes, is inevitably going to affect the others. For example, your tax strategy is going to impact your spendable income, your investment returns, and even the kind of legacy you're able to leave behind.
So we'll leave you with this one final thought. Just take a moment and think about your own situation. You don't even need to know the exact numbers, but can you just picture how your retirement savings are allocated across these 3 tax buckets? Because understanding your starting point, well, that's the first step on any journey.